Are you a resident of Ireland? Do you know how much tax you have to pay on your income? If not, don't worry, we've got you covered. In this article, we'll take a look at personal taxes in Ireland and provide you with a comprehensive guide to help you understand the tax system. Here are some tips to get you started. Know your tax residency status. Your tax residency status determines how much tax you need to pay in Ireland. If you are a resident, you are taxed on your worldwide income. If you are a non-resident, you are only taxed on income earned in Ireland. To determine if you are a tax resident in Ireland, you need to consider the number of days you are present in the country during a tax year. An individual is considered tax resident in Ireland if they are present in the country for 183 days or more in a tax year, or if they spend a combined total of 280 days or more in Ireland over a period of 2 consecutive tax years. First, you need to register for a personal public service number. A PPSN is a unique identifier used by the Irish government for tax and social welfare purposes. You need a PPSN to file your taxes. You can see a video about that in the link up there. Let's start with a real-life example. John is a software engineer in Dublin. He earns €60,000 per year. According to the Irish tax system, he has to pay 20% on the first €40,000 and 40% on the remaining €20,000. That means he has to pay €1,679 in taxes, including PRSI and universal social charge. Ouch! Now, let's dive into the details. According to Eurostat, Ireland has one of the highest income tax rates in Europe, with an average income tax rate of 23.8% compared to the EU average of 18.2%. This means that if you're planning to move to Ireland, you should be prepared to pay a higher tax rate than in other European countries. The Irish government has announced changes to income tax thresholds in Ireland for 2023. The standard rate tax band, which is the amount you can earn before you start to pay the higher rate of tax, will be increased by €3,200 to €40,000 for a single person and €49,000 for married couples with one earner. The income tax rates will remain the same at 20% and 40%. But there will be increases to tax credits and changes to the income tax bands in 2023. The value of the basic personal tax credit, the employee tax credit, and the earned income tax credit have all increased by €75 to €1,775. In Ireland, PRSI is a social insurance contribution that is deducted from an employee's pay and is used to fund social welfare benefits. The PRSI threshold is the minimum amount of earnings that an employee must earn before they are required to pay PRSI. The PRSI threshold for Class A employees, who are people in industrial, commercial, and service-type employment, is €38 per week or €1,976 per year. The PRSI threshold for self-employed persons whose income from all sources is less than €5,000 per year is €0 and they are not liable to pay PRSI. It is important to note that PRSI is separate from income tax, and the two are calculated and paid separately. The PRSI contribution rates for Class A employees, who are people in industrial, commercial, and service-type employment, are as follows. For weekly income up to €352, the employee pays no PRSI, and the employer pays 8.80%. For weekly income between €352.01 and €424, the employee pays 4%, and the employer pays 8.80%. For weekly income between €424.01 and €441, the employee pays 4%, and the employer pays 8.80%. For weekly income over €441, the employee pays 4%, and the employer pays 11.05%. The PRSI contribution rate for the self-employed is 4%, which is in line with the rate applicable to employee. The universal social charge is a tax payable on gross income from most sources, including notional pay, after any relief for certain capital allowances, but before pension contributions. 1. The USC rates in Ireland vary depending on the level of income. If your income is €13,000 or less, you pay no USC. Once your income is over this limit, you pay the relevant rate of USC on all of your income. The USC rates for 2023 are as follows. For income up to €12,012, the USC rate is 0.5%. For income between €12,012 and €22,920, the USC rate is 2%. For income between €22,920 and €70,044, the USC rate is 4.5%. For income over €70,044, the USC rate is 8%. The top of the 2% USC band increases by €1,625 to €22,920 in 2023. It is important to note that USC is separate from income tax and PRSI. and the three are calculated and paid separately. However, there are some tax credits and deductions that can help reduce your tax bill. For example, if you're a first-time buyer, you can claim a tax credit of up to 20,000 euros. If you're paying for childcare, you can claim up to 1,500 euros per child. And if you're a student, you can claim tax relief on your tuition fees. It's also important to note that Ireland has a self-assessment tax system. This means that you're responsible for calculating your own taxes and filing your tax return every year. If you're not sure how to do this, you can hire an accountant or use a tax software program to help you out. Another thing to keep in mind is that Ireland has a progressive tax system. This means that the more you earn, the higher your tax rate will be. So, if you're lucky enough to be earning a six-figure salary, be prepared to pay a lot of taxes. In addition to income tax, there are other taxes that you may need to pay in Ireland. For example, if you own a property, you'll need to pay property tax. If you sell an asset, such as a house or a car, you may need to pay capital gains tax. And if you receive dividend income, you'll need to pay tax on that too. Property tax in Ireland is an annual self-assessed tax charged on the market value of all residential properties in Ireland. The tax is assessed on residential properties, and the owner of a property is liable for the tax. The rate of the tax is 0.18% of a property's value up to 1 million euros. And in the case of properties valued over 1 million euros, 0.25% on the balance. Local authorities can vary LPT rates by up to 15% of the national central rate. Capital gains tax is a tax on the profit made from the sale of an asset, such as property or shares. In Ireland, capital gains tax is currently set at 33% for individuals and 25% for companies. However, there have been discussions about potentially increasing the tax rate for high earners. It is important to note that there are exemptions and reliefs available for certain types of assets, such as a principal private residence. Additionally, capital gains tax can be offset by losses from other investments. It is recommended to seek professional advice when dealing with capital gains tax in Ireland to ensure compliance with the law and to minimize tax liability. Dividend tax rates in Ireland vary depending on the individual's tax bracket and the type of company paying the dividend. For higher rate taxpayers, the tax rate on dividend income can be up to 52%, which includes 40% income tax, 4% PRSI, and 8% USC. Dividends paid from a trading company that is a tax resident of the European Union are taxed at a corporate rate of 12.5%. The legislation stipulates a lower or 0% withholding tax for the distribution of dividends if Irish double taxation agreements are enforced. Ireland has the highest top dividend tax rate among European OECD countries at 51%, followed by Denmark and the United Kingdom at 42%. In conclusion, personal taxes in Ireland can be complex, but with some careful planning and a little bit of help, you can make sure you're not paying more than you have to. Just remember to keep track of your income, claim any tax credits and deductions you're entitled to, and file your tax return on time. If you enjoy watching our videos and want to stay up to date with our latest content, we encourage you to subscribe to our YouTube channel. Subscribing is quick and easy, and it ensures that you never miss a new video.